Welcome everyone to our update for the quarter ended September 2020. I'm going to take you through investment returns for the quarter, year and 3 years, and then I'll pose the question, can markets keep going? At the time of my last update, we had 2 consecutive extraordinary quarters. Extraordinary for very different reasons, but extraordinary nonetheless. So from super subnormal to super normal, we've now come to new normal during the September quarter. We all emerged from lockdown, with the notable exception of Auckland, which went back in and back out of lockdown during the quarter. The Mitre 10 Cup kicked off with a victory for Canterbury over North Harbour. Markets continued their recovery that they began in the June quarter, and we started to feel a little bit like that much loved, for we're not always sure what reasons, Groundhog Day movie starring Bill Murray. The same thing over and over. This slide shows the growth of $1 invested for the September quarter. Leading the way here is emerging market shares, which would have grown to $1.07 during this 3 months. In second place is international shares in the developed markets this time, hedged to the New Zealand dollars, which would have grown to just under $1.07. A 50-50 mix of cash and fixed interest and shares would have grown to around about $1.03. Not bad, a bit of a letdown from the big numbers of June, but actually a more normal return. 3 months is interesting, but not particularly informative. What about the year? Well, doesn't this slide look interesting? And very much like a V. We begin with the December 2019 quarter, with markets going steadily up. And then in the March 2020 quarter, we have a precipitous drop, followed by, in June, an almost opposite rise, and then reverting to somewhat more normal in September, this quarter. For this 12-month period, the leader would have been New Zealand shares, where $1 invested 12 months ago would have grown to around about $1.08. In second place again was international developed markets hedged to the New Zealand dollar. That would have grown to around about $1.07. Still a few asset classes that were below $1, including a 50-50 mix of cash and fixed interest and shares, which would have grown, well, almost grown, to about 99 cents. But what about 3 years? What about a more meaningful time period? This slide shows the growth of $1 over 3 years. Leading the way again, resplendent in purple, is New Zealand shares, where $1 invested 3 years ago would have grown to around about $1.52. In second place, also again, is international developed market shares hedged to the New Zealand dollars, which would have grown to a very respectable $1.24. In third place is a 50-50 mix of cash and fixed interest and shares, which would have grown to around about $1.21. Actually, that's the long run return for this kind of investment. Pretty interesting. That March 2020 quarter still stands out, but overall, every asset class that we measure here has finished the year up. This is despite, seemingly in spite of, the fact that we haven't got a COVID vaccine, a number of countries are still in lockdown, and economies aren't faring particularly well. This disconnect between economic performance and market performance was something I discussed last quarter. Feel free to watch again if you need a refresher. That 3 years has been really interesting, as has the recovery in the last 6 months. But it does raise the question, can markets keep going? Or will they crash again? It's certainly one that we've been hearing. Markets have recovered really well. The S&P 500, which is the main stock market index in the United States, took 126 trading days to recover all of the value lost in the COVID crash. It recovered its value on the 18th of August. That's actually the fastest recovery from a bear market, which is a big drop of 20%, on record. The FTSE is still a little bit down, but you might argue that that's due to Boris and Brexit. The New Zealand market hadn't quite made it by the end of September. It was still slightly below its peak in February, but by the 8th of October, it was there, and by the way, it's kept going. The Japanese Nikkei just squeaked in It recovered all of the COVID crash value by the 29th of September. All of these markets have responded despite all this economic data, and they've kept going. The trend has been upwards. Can it persist? The answer is maybe. Interest rates are now lower than the low they began the year with. This is on purpose and part of a coordinated response by central banks and central governments around the world to deal with COVID-19. Interest rates have a stimulative effect. When interest rates fall, it's much more attractive to finance houses, cars, boats, furniture. All of that flows through to the companies that make those things. They can employ people who will themselves spend on these things. They can grow their profits. And that, all things being equal, is good for their share price, which is good for markets. Another way that interest rates affect markets is via the time value of money. When we buy a share, we're buying the future income stream from that company. That means all of the dividends, all of the profits that that company will ever pay from now out into eternity. In part, this is because of how we value money. A little bit of a bird in the hand is worth two in the bush. What that means in an economic sense is that we value money now more than we value money in the future. In part, that's because we can invest the money we have now and earn a return. When that return is low, the differential in value between future dollars and current dollars is lower. That means that we are happier to value future dollars more than we did before. That tends to be good for markets because remember, when we're valuing shares, we're valuing the future income stream. So if we're valuing the future income stream higher, that will, again, all things being equal, lead to us valuing shares and therefore markets higher. Another way that interest rates affect the way that we value markets is opportunity cost. When we're thinking about investing in a risky asset, our next best alternative is a lower risk asset. When the return from the lower risk asset is really low, like it is right now, the return we demand from the riskier asset might be lower. If the return we demand from the riskier asset is lower, that might mean that the price is higher. That also tends to be good for markets. The final way that interest rates impact returns is in the form of higher valuations in general. Everything we value with reference to something. In this case, it's interest rates. Again, how do we discount the value of an asset that we're purchasing? Be it a property or a company that owns one or several properties, we discount it with reference to the interest rates. When those interest rates are lower, and we can think of this a little bit like a fraction, the value is on top. The amount we discount it by is underneath, the denominator. If the denominator goes down and nothing happens to the numerator on top, the overall value goes up. That's what happens when interest rates fall and valuations change. Notwithstanding COVID-19 and the impact on global economies and markets, the dominant input into financial markets at the moment is interest rates. Those low interest rates, which are likely to persist for a significantly long time period, will have a significant impact on returns. That means that you as an investor need to consider if your strategy remains appropriate. Will it earn you the return you need to fund your lifestyle or to grow your capital so that you can fund your lifestyle in the future? It's a good idea to check that strategy, but remember, now's not the time to be getting out of risky assets. I've just explained to you that there's a rationale that the low risk component of returns is actually going to support risky assets moving forward. That is, by the way, what we've seen already since the end of the COVID crisis, at least from a market sense. Our advice remains the same. Stay disciplined and stay invested. I hope you found this market update helpful, and I look forward to updating you again next time.